Hello, I'm Ion-Marc Valahu, Chief Investment Officer at ClairInvest. And after the events of last week, where the Fed starting their rate cutting process, they started with a 50 basis points cut. And that was the first cut since 2 years, actually, when they stopped hiking rates at the end of 2022. And I thought it was important to take a moment and to see a couple of asset classes that will benefit, if we look on an historical basis, that will benefit from the cuts coming from the Fed and, of course, other central banks around the world, but the most important one would be the Fed, which controls the value of the dollars and the interest rates in the US. So if we look on the graph, on the first graph, that's the DXY index, which is a basket of currencies against the US dollars. We can see the dollar has been very strong all the way up to the end of the hiking cycle from the Fed. So end of 22, beginning of 23. And now the dollar has started to consolidate. So that's really important because the dollar being strong has held back a lot of the sectors and assets around the world. And now that we have a little bit of easing in the dollar facing other currencies, some of other sectors will start to benefit. So first of all, let's look at history and see what happened every time the Fed started a cutting cycle. As you can see from all the way back to 1970s, as soon as the US dollar started to consolidate and even weaken after the Fed cut rates, you have gold that starts to perform again. Over the last 2 years, of course, the gold has also performed, even though the dollar was strong. That's more related to the effects, long-term effects of inflation we've had over the last 3 years. Now, inflation is still really high on a personal level for consumers because the 30% increase in prices over the last 2 years is still there. It's just the rate of increases that is starting to go down. And now the rate of increase is hovering around 2.5 to 2%, which is about the Fed target. But that does not take away the fact that prices are 35% on average over the last 2 years. That's really hard on consumers around the world. And all the prices affect consumption and spending and even raw materials. So the gold, it will continue to perform now that the dollar is on a downtrend move. And if we look at some other assets that will benefit from this dollar weakness and interest rate cuts, emerging markets are one of the big beneficiaries of this move. As you can see also on a historical basis, every time the US starts to cut rates, emerging markets start to come out of the doldrums and start outperforming US equities. One of the major factors that a lot of those countries borrow in dollars, they do business in dollars, they buy commodities in dollars. So every time the dollar is strong, it kind of slows down their economy. Now that the dollar has a tendency to move down after the first rate cut, and maybe the Fed will cut again, then there's a benefit to being invested in emerging markets. Those emerging markets can also include China. China is another issue, so we will talk only about emerging markets, which represent a large part of the world's economies. We can move also to the commodities. That's also another asset that benefits with a lower interest rates. Commodities have been also hurt, first of all, because the trading volume has decreased for the last year. And also a lot of the economies have been slowing, including China. But now that the dollar is weakening, we can see a shift because valuations have moved down so much. And as I can see from the Bloomberg commodity index here, you can see that commodities have been hurt a lot by the strong dollar and the high interest rates. And this is also an asset that will benefit and has also benefited over the years during periods of slower and weaker US dollars. The fourth asset that I want to talk about also, you can see it also, this graph coming back to emerging markets. More precisely, we can go back to bonds also. Emerging markets do finance themselves in dollars, and therefore, as soon as the dollar starts to weaken, they're able to pay back their debt. They're able to issue new debt if they need to. And so we're already starting to see, after a major correction over the last 5 years, a major rebound in emerging market bonds that should carry forward because the expectations for the Fed is for another cut of 25 basis points next month and maybe another 25% cut in December before the new year. And of course, I want to talk about one of the assets that will also be a problem for next year, but that's another issue for next year, of course. But inflation is a potential to come back on the forefront after having slowed down a lot, because as we can see, gold is not cooling down, even though some of the inflation is slowly reducing. So therefore, if we summarize what we just talked about it, I think that to shift a portion of your portfolio away from Magnificent Sevens or just plain and simple large caps and moving into small and mid caps in the US, moving to emerging markets on the equities and on the bonds, allocating a portion of your assets to gold should weather and outperform other indexes of large capitalization stocks. Thank you for listening and happy trading.